I will tell you something that most trading educators will never admit. Trendlines and patterns, probably one of the most popular methods in tactical analysis. They are taught everywhere. Literally millions of traders use them every single day. An interesting part is almost all of them are losing money. It's not because they are bad traders, but because they were handed a broken method and told it was working. Let me tell you the truth. Drawing a line or looking for shapes has zero technical value. It tells you nothing about where money is actually flowing. It ignores time, it ignores liquidity. What you are literally doing is connecting dots on a chart and assigning imaginary meanings to the shapes you find. That is not analysis, that's astrology with a price chart. And here is the part that should genuinely disturb you. When you draw a trend line, you are connecting the exact points where institutional players exited their positions. Those are liquidity points. And when you trade those trend lines, when you wait for that breakout and retest like you were taught, you are not trading the market. You are being used by the market. You are the exit liquidity. Now I know what some of you are thinking. You will say, but I have seen these patterns work. I can pull up my chart right now and show you. And yes, you are right, you can. But here is what you are missing. Your brain is working against you. The human mind is wired to find what it already believes. So when you scroll through historical price chart, you will naturally spot every single time a pattern worked. Your brain will quietly skip right over the hundreds of times it failed. That's not confirmation, that's a cognitive trap. And it is keeping you unprofitable. These patterns are so broad, so generic that of course price will occasionally break a trend line and move in the expected direction. Price lives on an X and Y axis. It can only go up or down. If price is destined to go up, sure it will break some trend lines on the way. But that doesn't mean trend line made price to go up. That doesn't mean it will happen the next time or the time after that. So what I'm going to do today is going through real charts with you. And it is going to be uncomfortable. Because I'm going to show you not just where these methods fail, but why they fail structurally every single time. And then I'm going to show you what you should be actually looking at instead. If you are ready to stop trading shapes and start understanding the market, let's get into it. In our first example, price was making accumulation here, then strongly left this consolidation area and came up until here. So how pattern traders think? Price is making kind of this bull flag. You can call it falling wedge and declining channel. So let's play out a little bit. So how retail traders would enter this trade? As their approach, here is a breakout point. Price break this trend with a strong up candles. So retail traders will be bullish on this. And after making this bull flag and also breaking out here and retesting the same level, their target usually like this. Let's play out and see. As you can see, they all fail. Let me clean this line. So retail traders sees this point as an opportunity. After retesting, they will be buyer here. If you also place your buy position at this point, you will be probably buying from smart money. Because smart money was accumulating their position at this low. And up here, they are gradually exiting their position. So institutional traders will sell their position to you above these specific points. Where they actually exit their position, you are gonna be buyer here. You will be counterparty for their huge sell orders. Because probably they've been accumulating their buy positions here and gradually exit their position above these specific points. That's why they drag price above specific high and below specific low, so that they will create liquidity pools. Only by doing this they can match their massive positions, because if they cannot find counterparty to exit their positions, they cannot efficiently match their sell orders. But what pattern and trendline trading is telling you that you should enter the position where they exit. So if you follow this methodology, you will be only exit liquidity. You will be fuel for the next price move. Let's see our second example. When you look at this chart, you can easily see this inverse head and shoulder pattern. Here is the neck of our pattern. So what pattern trading tells you is that when you see such pattern, wait until price goes above this neckline, retest and enter position somewhere here. And how they measure the target for this pattern? They will say first target is here after breaking out, and the second target is here. Let's play out and see what price did here. Let me clean this line. So price did break out here once and second time here. You will enter long position at this high and probably you would place your stop loss at this low. Your first target is here. So what actually happened? If you entered this trade, you got stopped out at this low. I was even generous to place my stop loss at this low, because normally they place their stop loss below this low because they think price already break this neckline. So it's not supposed to come down and take this low. But even if you set your stop loss somewhere here, you would be stopped out. They push price up, By pushing the price up, smart money matched their sell orders with breakout traders' buy orders. So they exit their position here and afterwards price drastically dropped. Let me show you our third example. In this example, you can easily detect this cup and handle pattern. So what this pattern tells you is that after price break this neckline, it will retest and bounce. So what is their expected target is that from neckline till this low. So if pattern traders enter position here, they would place their stop loss below this handle and their target is here. Let's play out and see what happened. As you can see, price drastically came down. So smart money deliberately pushed price up above this point so that when retail traders see such movement, there will be excitement. There will be bunch of breakout traders buy order. So this price meant to come down. It's obvious that we were on a downtrend. After smart money creating such excitement about this neckline, all breakout traders stop loss got hit here. Even if you place your stop loss somewhere here, you wouldn't survive. So let's see our next example. This is very interesting. As some of you may know, retail traders highly respect double bottom and double tops in price chart. But in my opinion, they are the most dangerous one. You can clearly see our double bottom. So what this pattern tells you is that if price breaks out this neckline with strong up candles and retests, so the target is measured like this from this neckline till this low. Let's see how it's playing. So of course this one has also failed. So liquidity is only thing that matters in price chart. By creating such range below this low and above this high, there are a bunch of orders. So if you trade these breakouts, there is high chance that you will be exit liquidity. You will be fuel for the next move. If you buy here, you will be buying from smart money. Smart money's sell order will be matched by buy orders above this neckline. And after taking this high's liquidity, price directly aims below this double bottom. Because below this double bottom, there are a lot of sell stop orders. And also breakout short orders, which are also sell orders. Let's see our next example. In this example, you can clearly see prices accumulating in a tight range. If you are trendline trader or pattern trader, you will immediately draw this line. You will assume that this is a downtrend and price is stuck on a narrow range. You can also say that this is a bull flag. But it really doesn't matter what shape you see, because this is a monkey science. This has nothing to do with technical analysis. You just connect the dots. I think anyone can do this. And frustrating part is that people think this is analysis. Price will move according to these shapes. But reality, no. They just create liquidity pools. They just engineer price. By creating such shapes, there will be a lot of buy orders above this level and below this level. So normally how this is working? They take this flag as their target. If retail traders see price breaking this downtrend with strong up candles, price might go to this target. But as I said, this is far from truth. So by drawing these trend lines, you actually connect all these liquidity pools. Above all these highs, there will be bunch of breakout traders buy orders. And you can also think like this. If you short above one of these highs, where would you place your buy stop? Because if you short, your stop loss will be buy stop. Probably you would place your stop loss order above these highs. So if smart money push price above these liquidity points, they can easily match their massive sell orders with these buy orders above this point. Let's play out and see. So you can see clearly here. Let me clean the chart. So price break this downtrend with strong up candles. Price went sideways for some time. Then it strongly came down. So why price did sideways here? Because smart money was accumulating their sell orders. Every time price went up, they match their sell orders with buy orders. When retail traders see this pattern shaping and also see this breakout, they will be eager to buy above this point. So every time they place their buy orders, smart money was counterparty with their sell orders. After smart money matched their sell orders here, price pushed down. And if you buy this price somewhere here, you would place your stop loss either this low, and this low. And as you can see, price took all this low's liquidity and it went far below. So I hope this video opened up your eyes a little bit. I know some of you might put a lot of work and time learning these trend lines and patterns. And I also know that it is hard to accept these things actually don't work. These methods will not give you sustainable gains. I mean no disrespect. 10 years ago I've been trading these. That's why I'm confidently sharing with you that these don't work. I don't want people waste their money and time using these methods. Another question is what you can do instead of using trend lines and patterns. That's actually why I made this channel. I consider consistently sharing technical analysis teachings and my trading strategies. I will add my playlist at the end of this video. I highly suggest you watch all of them. And if you want to support me, please like this video and subscribe to my channel and share your thoughts in the comment section. I read all the comments. So until next time, take care.